Well, thanks so much for having me virtually at the SAFE conference. So this is it's a paper I work with Mike Brolley on another solution to solve the latency arbitrage race. And we think this is a better solution, and I'm going to explain to you why are we so excited about it. Okay. So, perhaps this is well known to the audience, but latency arbitrage is costly, right? So there is evidence, most recent presented by Sabrina Buti and O'Neill in 2020, showing that HFTs are rushing to trade on short-lived opportunities, and these races are frequent, like about 500 a day in each symbol in the FTSE 100 stocks, in the largest stocks in the UK. They happen in a blink of an eye, or much faster than that. The winner, when they reach the stale close, they're faster by only 5 to 10 microseconds. Obviously, because this is a race that can be won only by the top firms. Latency arbitrage is very concentrated. Only about 6 firms win almost 90% of the races. And what Sabrina Buti estimated that latency arbitrage is costly. It's a daily tax of 42 basis points, 0.42 basis points of the total trading value. And they estimate that this can reduce liquidity by 17%. So obviously the industry and the academic world has been aware that latency arbitrage is a problem, so they try to come up with innovative market design solution that all have been focused on eliminating the races and improving liquidity and reducing the spreads. Two of the most well-known such measures are speed bumps, which has been implemented in various places, and batch options, right? So moving from continuous trading to discrete time trading. And these measures work very well in theory to improve liquidity because they essentially eliminate latency arbitrage altogether. But what they're not concerned with is necessarily the revenue for exchanges and incentive compatibility. So would an exchange actually want to implement these measures? And there's another paper by Buti and Shim saying that, well, even though it might give you a very short-lived advantage, everybody will replicate it, and you essentially compete revenues to zero. Because most exchanges nowadays, what they get their money from is not really like trading fees, but is data fees and colocation fees. So if you kill one source of revenue for high-frequency traders, you're killing revenue for exchange. And both speed bumps and batch auctions are not very hard to implement, but they do require tinkering with the current market design. For example, batch auctions, if implemented unilaterally on an exchange, well, it's very hard to define what's the best bid and offer then on all exchanges. So you're going deeper into the whole structure. With speed bumps, it's a little bit easier, but then again, they're having complaints, including from Canada, that if you delay one market, then you give a last look to some market makers. So while they look nice in theory, they're not necessarily, these measures are not necessarily incentive compatible for exchanges, and they mess a bit with the current limit order book system. So here comes our solution. Our solution it's on the face of it very simple, is to have a microburst fee. And I'm going to go in detail about what we think by microburst fee. So at the very core, right, it's a very nice, from our perspective, very nice, economics-based idea. It's to search price speed, right? The way the Uber is search pricing when there is higher demand and supply. So speed is not equally valuable at all points in time, right? Speed is only valuable when HFT is discovered. There is a signal. There is an arbitrage opportunity to be exploited. So we want to make the price of speed actually follow the emergence of such opportunity. So speed is more costly when it's more valuable for HFTs. So how to do this? Well, we thought, okay, let's put a fee when there are there are this kind of microbursts, when you see a lot of HFTs trying to trade, trying to being aggressive on the same stale quote, you have a microburst fee. So we think of this as a fee per message. If you see multiple message in the same millisecond, and I'm going to be a bit more precise in a second, and the fee level in principle should increase with the number of liquidity trading orders. So the more people you see crowding on the same opportunity, the higher fee you want to charge them. And the hope is that this kind of fee will capture in real time what the market price of speed is. So that will price in latency arbitrage. And because this is a fee rather than just moving to batch auctions or putting a speed bump, by definition, it will produce some revenue for exchanges. And this revenue can partly or perhaps even exceed the revenue loss from colocation fees. So let me show you a very brief schematic where we are now. In a world with colocation fees, there are latency arbitrage rents to be exploited. The HFTs are capturing a part of these arbitrage rents. They're paying some. They're sharing their profits with exchanges through colocation fees. And who bears the cost is the investor, who have to pay higher spreads and support lower liquidity. And that's basically what the Aquilina, Bullish, and O'Neill find this 0.42 basis point stacks. The ideal world, right, based on the papers on batch auction and speed bumps, what they envision in their design is a world where there is no latency arbitrage. So there's no profit for HFTs, there's no profit for exchanges, and there's no cost for investors, right? So that in some sense is the first best. So where we come in and say, hey, maybe exchanges won't have any long-run incentives to go for this. So we're proposing this. It's a world with microburst fees, in which and we show that's going to happen. There are still latency arbitrage rents, but the exchange is better able to capture. So the exchange will actually get all the latency arbitrage rents, leaving the HFT with nothing. In order to make the exchange as happy as if they charge colocation fees, you actually are reducing the size of the pie. So the total latency arbitrage rents are lower. You're eliminating the HFT part of the pie. So therefore, the total cost for investor is lower. So even though they're worse off than under the first best, they're better off than in a world with colocation fees. So that's sort of the approach we're taking. We're not trying to eliminate the pie altogether because that's not going to make exchanges happy. We're going to reduce the size of the pie, make investors better off than under the status quo, and perhaps allow the exchange to implement this. So how do we think this? Well, we think of a fee, in a very abstract way, as depending of being a function f of a scale parameter phi, right? So that's going to determine the magnitude of the fee, how binding the fee is, and the number of messages in the cluster. So obviously, if you have no messages, the fee would be 0. If you have a single message, right, that's not really a cluster, so the fee would be 0, right? If there's a random message arriving at any point in time, you're not going to charge them. You are going to charge them when multiple messages arrive within the same cluster, right? So the fee will be increasing in the scale parameter and increasing. This should be a larger equal sign, weekly increasing in the number of message, right? And when we talk about cluster size, from our discussion with people at IEX and TMX, we feel like this should be somewhere between 100 microseconds up to 10 milliseconds. It could be. You will compute this intraday, right? Because you want to look at exact clusters, but you don't have to charge them in real time. You can tally them up at the end of the day and charge them then, or even like a monthly bill. This is how many clusters you've been involved in, and that is how much you have to pay. And what we're arguing is that this is going to be, this is not going to harm, occasional investors. We are unlikely to accidentally pay these fees if you're just stumbling onto being in a microburst. because the duration of all these races throughout the day, from what Buti, Aquilina, and Neil estimate, is 0.05 seconds. So you're very unlikely to just stumble upon them. Right, so how would you implement this? We got a lot of comments from exchanges. Okay, how would you do this in practice? Well, in practice, you want to capture all the messages before they reach the exchange, right? So before they reach the firewall, and then basically look at the timestamps and have the timestamps basically very, very, very close to each other, right? Within the same cluster. How would you define orders that belong to a cluster? Well, you have to have multiple, 2 or more aggressive orders on the same stock, on the same site, and at the same price level. Unique user ID, so it has to be the same firm, but it could be different trading desk between the same firm. And we define an aggressive order as a limit order or immediate or cancel if it's a buy at or above the best ask, or a sell at or below the best bid. Right? And we want to have in every microsecond that some orders are succeeding, that some orders are executed, and some order fail, either it obtains zero quantity or they expire. And importantly, and that's from an implementation point of view, the toughest is that the orders arrive at the same time. And what does the same time mean? Is that they cannot possibly react to each other, right? So it cannot be the case that I see the message of some other trader being executed and I send mine, right? So the actual engine latency is the time that it requires for me to observe the other message coming in. So that's between 100 and 300 microseconds, depending on how busy the server is at a point in time. And then my reaction time to see that is about 30 microseconds from our discussion with the industry, and based on the data in Aquilina, Buti, and O'Neill. So we want all these traders to react at the same event. And that happens if you have a microburst calibrated to be somewhere in the ballpark of 500 microseconds. Okay, so back to the theory. What do we care about? We care about 2 variables here. Yeah, we care about the spread, we care about liquidity, and we care about the race intensity. What's the probability of an HFT to race on a short-lived signal? So the mechanism here goes as follows. If I have to pay a fee, and if this fee increases in how many other people are competing with me in the race, then if the fee is high enough, I'm just going to probabilistically snipe. Sometimes I'm going to send a sniping order, sometimes I'm not. And because not everybody is jumping on every opportunity, but we're only doing so probabilistically, that's going to increase the market maker's chances of actually updating the quote, will reduce adverse selection cost, and will potentially lead to a lower spread. So unsurprisingly, this is exactly what happened, right? So here we have the congestion fee slope, so the parameter, the phi. Here we have the half spread in red. So you see the higher the phi, the lower the spread, and the higher the phi, the lower the probability of sniping. So an interesting thing here, based on what I just said, well, it's probably pretty clear that if the probability of sniping goes down, there's less adverse selection risk. The market makers are better off. They can reduce the spread, so the spread will go down. But why is the spread going down, even if the sniping probability is 1? And this argument, it's a bit more interesting. So having to pay a fee every time you are sniping actually reduces the probability of sniping, reduces the profitability of being a sniper, which reduces the opportunity cost to be a market maker, right? Because if I'm not posting quotes, then I always have the outside option to snipe other people's quotes. But if all of a sudden sniping other people's quotes has become less profitable because I have to pay a tax, then the opportunity cost of providing liquidity is lower, and therefore I can post a lower spread. right? So you can have an improvement in liquidity even if you see the same number of messages arriving in the same race, right? And the other comparative statics are what you would expect. If the size of news increases, for example, you have a higher probability of sniping and a higher spread because simply the cost of adverse selection is higher. So what's the perhaps more innovative part of the paper is how we relate to exchange revenues, right? How much revenue can these microburst fee actually bring exchanges? So here you have two channels. You have a direct effect. So if you bump the fee up, right? If you increase the scale parameter, obviously you're going to have higher revenues for each sniping message, for each sniping trade. But there is an indirect effect, as we've seen. If you have a higher fee, then HFTs are going to be disincentivized to snipe. So they're going to snipe less. They're going to kind of have less intense races. So you're actually going to collect a lower number of these fees, right? So you end up with a nice hump shape like this. At first, when you increase the fee, you're increasing revenues, right? People here are still sniping 100%, right? So if the fee is low enough, you're not deterring HFTs to snipe, but you're just increasing your revenues by charging more. And then after a while, the fee is high enough, and HFTs say, well, for this fee, I might or I may not snipe. So that will actually push the total revenue down. So what I'm saying is that there is this phi bar that actually maximizes the exchange revenue from microburst fees. And how does it compare to collocation? And there is an interesting point in Aquilina, Buti, and O'Neill that they argue that collocation fee actually lead to capped revenues. So because an HFT has to pay the fee on all exchanges because they don't know where the arbitrage opportunity is going to show up, that actually reduces the amount that exchanges as a whole can extract from HFTs because they're essentially competing ex ante on the fees. Whereas with microburst fee, you see the arbitrage opportunity on a given exchange and a given point in time. So then that exchange has a temporary monopoly on speed, right? That's where you want to trade. So it has the opportunity to extract much more rent from HFT. So in fact, the entire latency arbitrage rent, because at that point in time, it's not really competing with anybody else. That's where you want to make your trade. So if we're localizing these races in time, we're actually allowing exchanges to extract higher rents than if you have to make an ex ante subscription and then wait to see where the opportunity arises, right? So the fact that you don't make HFTs commit ex ante reduces their ability to discipline exchanges and reduce fees. So what we actually show in the paper is that for a range of microburst fees, exchanges in a two exchange setup can actually be better off from microburst fee than from collocation. So you can actually improve revenue for exchanges, not just match them, right? So what we're interested in now is to see, well, what is this interval and how realistic are the microburst fees that you can potentially set? A side note here, the actual shape of the microburst fee doesn't matter for the peak of the curve, right? At the peak, the exchange can extract the full rents from latency arbitrage, regardless of whether this is like a constant fee, if you have a cluster with two more orders, or a linear fee, or a quadratic fee, right? And in the paper, we focus mostly on these two cases, and for calibration, we focus mostly on the constant because it's perhaps the easier to understand. But the maximum revenue is independent of the shape. All right. So we have a variant of the model with a fragmented exchange environment. HFTs pay collocation on all exchanges. And in this case, the exchanges do not compete profits away. With a microburst fee, exchanges might, in the short run, exchanges might in the long run compete profits away, because every exchange wants to capture the entire revenue. Every exchange wants to set the fee high enough so that all the trading happens on that exchange. So they will do a Bertrand competition in which they increase the microburst fee, essentially eliminating the arbitrage race, and that will go us back to the same problem that batch auctions have. In the long run, nobody would want to implement that. The solution to this, in the context of microburst fee, I think where it's a bit easier than in the context of batch auctions, is to simply put a cap on fees, right? And that's exactly what happens in practice. Under Reg NMS, there is a 30 mil cap on the fee that can be put per share, right? Per traded share. So we already have these caps. Once you have a cap on the fee that you can charge, exchanges know that they will not compete all the profits from microburst fees away, because they have to stop at the cap. So they're going to be that's going to allow them in the long run to sustain this equilibrium of charging microburst fee and not reverting to collocation, right? So the optimal fee from a social planner standpoint, it's here, right? It's at this point of the intersection. So for this fee, the microburst fee are incentive compatible. So exchanges are not worse off. They get the same amount from microburst fee done as they do from collocation, and the fee is the highest possible, right? So that will lead to the narrowest possible spread under incentive compatibility and the lowest possible HFT sniping intensity. So if you're a regulator and you want to set a cap, you will set it here. And that means that exchanges can never compete collocation profits away, right? Because they cannot move to the right on this curve, and they're always going to be better off, and liquidity is always going to be better than under collocation. So if we make a calibration of what that fee would be about, the cap is actually pretty lax. It's $3.98 per message, which is like 30 cents per share traded, let's say, if you look at the lot of 100 stocks. So the fact that this number is so outrageously high actually works in our favor, we believe. It means that the regulator doesn't have to use a hammer to sort of like fix incentives for exchanges. He can set a pretty relaxed cap that nobody will actually reach. What else do we find with our calibration is that the maximum revenue maximizing fee is about 34 cents per message, or about 30 basis points per stock. But really, any fee above 7.8 basis points per share, which we think it's potentially feasible and realistic, would both generate higher liquidity and collocation fees, and provide higher revenues than collocation fees. So the 7.8 basis point, it's actually here. This would be 7.8 basis points, and this would be 30 basis points per share rather than per message. So this is the range that we can, the range that we are essentially looking at. What's the closest implementation in practice to what we're proposing is the IEX scrambling code remove fee. So that was a fee on liquidity taking orders when the IEX assessed by means of its signal that an HFT race is about to happen. And that in spirit is close to what we're proposing. The advantage of what we're proposing, I think, is that our solution is much more market-based in a sense. In the sense that the microburst fee do not depend on the signal that can be arbitrary or can be gamed. It really depends on the revealed preference, on the behavior of HFTs when they actually act on a signal that's in concert, that's when we want to impose the fee. Now, a disadvantage of this, like the flip side of this coin, is that there is some uncertainty, some ex-ante uncertainty in the fees that HFTs might need to pay. Well, over many races, over many days, I think a law of large number kicks in, and the revenue, the total cost is sort of fixed or sort of predictable. And from political perspective, an HFT could always say, well, I'm only providing liquidity, I'm not participating in this sniping fee. So in theory, I shouldn't even pay this unless by complete accident.
Marius, I don't want to cut you off, but if you could speed up.
Okay, I'll just show the conclusions. How the microburst fee related to speed bump and batch auctions? Well, it's not as good in improving liquidity as either speed bumps or batch auctions, because we claim that these are very idealistic views, but it's much better in providing exchange revenues, and it doesn't really alter the fabric of continuous time limit order books. It doesn't distort time. It doesn't distort the entire infrastructure. So it could be easier to implement. Is not very intrusive in market design, and that's all we had. And thanks so much for your attention. I'm looking forward to Sabrina's comments.
So first of all, thanks a lot, Christian, for inviting me to discuss this paper. It is a very interesting paper, very ambitious. And, with sort of this new policy suggestion on how to solve a problem that has been sort of triggering a lot of discussion between practitioners and academics. So, I'm a theorist, so I will take a little bit of the broad perspective. So why do we not like low latency arbitrage, first of all? Well, the problem with latency arbitrage is that we get rents from hitting stale quotes, but after public information signals. So the problem is that basically this profit opportunity is easily available to everyone, but the tricky point is that you need to be the first one to hit. So first of all, we have a wasteful arms race for speed, but it gets worse than that. So the problem is that because of this additional adverse selection component, we don't have a spread that is made of the two classic components we all know in market microstructure, that is asymmetric information and inventory cost. And we have an additional component that is due to this adverse selection from symmetric information. So clearly negative effect on market quality. And this is exactly what Marius and Michael, were sort of trying to solve with their policy proposal. What is the source of this low latency arbitrage? Well, Buti, Crampton, and Shane basically show that it's due to a flow market design in electronic market. Time is continuous, but exchanges need to process orders sequentially. So even if everyone arrives at exactly the same identical speed, one has to be first. So given that this comes from, a market design mistake in a certain sense, can we do something by using a market design tool? So again, the main problem is this adverse selection impact on liquidity. But there is an additional problem that Marius stressed very well, is that exchanges extract revenues from high frequency trader and may have incentives, zero incentives to curb their activity. So the real challenge here in terms of market design is not only to find a market design proposal that reduces low latency arbitrage, like, frequent batch auction or speed bumps, but it should also be incentive compatible. So basically, exchanges need to gain more at least as much as than with collocation fees, and the design should be competition proof. So now here is the idea, to use a market-based solution. So this Microburst fee, so this fee that targets only liquidity taking orders submitting during high frequency message clusters. So this is definitely not a make-take fee that targets all liquidity taking orders. This only targets when we have this, liquidity taking orders in the super speed cluster. And, I don't want to dwell on this because Marius explained this very clearly. So just, a quick snapshot at the main ingredients of the model. This is a sort of standard model, is one trading period, no asymmetric information, a little bit of the two classic type of risk neutral traders, strategic, HFTs, who can submit market and limit orders, not strategic, noise traders. I think in the paper they're called liquidity traders, but basically they just submit market orders. The limit order book is a bit simplified because we do have price and time priority. However, due to some, I guess to keep the model simple, that is totally understandable, basically only one unit can be exchanged. So whenever we talk about liquidity in this paper, we're talking about the spread. There is no role for that. Latency arbitrage is due to public information under the consequent stale prices. And of course, we have this Microburst fee, and applies to all cluster liquidity taking orders, whether they're filled or not. And the Marius stressed this. The design is a little bit tricky, but challenging a little bit for HFT because it's determined ex ante by the exchanges, but the exact amount that you pay will depend on how big is the cluster of orders. So in a certain sense, it's determined ex post. Main results. Well, Marius already said this, so we can extract larger rents exchanges can extract larger rents compared to collocation fees, but a regulatory intervention is needed to incentivize adoption of this system. And basically what the regulator needs to do is to cut competition, prevent competition from becoming too strong and eat away all profits. And so discourage exempted adoption of the fee. Why exchanges would adopt this fee is in the end, they have no profits. In terms of effectiveness, the Microburst fee reduces low latency arbitrage by decreasing rents from sniping. So we have lower adverse selection and tighter spreads. How effective it can be. Marius highlighted a little bit the calibration result. It seems that even with a reasonable fee level, you can really get substantial improvements in the spread up to 70–80%. So this sort of the broad picture. Now let me start getting a little bit more into the details. So I would start by an observation about how the equilibrium works. Marius didn't have so much time to dig into this in his presentation. So high frequency traders here can either be market makers or snipers, and this just depends on the arrival orders. The first HFT to arrive is going to say, I'm going to be the market maker and post my limit orders. Everyone else will automatically become a sniper, of course, if there is a change in public information. So the probability of sniping really depends on the level of the sniping of this Microburst fee. So if the fee is low, then everyone snipes and you have a pure strategy equilibrium. And this was what Marius showed in the picture one, the sniping probability stay at 1. At the high level of the fee, then it becomes too costly to snipe always, and you have a mixed strategy equilibrium. The spread is basically should be such that the profits for being a market maker as a sniper should be equivalent. And here comes my first comment. So the feeling that you get from the model is that high frequency market makers as snipers are the same market players, are absolutely equally fast, and they just swing between market making and sniping roles depending on the speed lottery outcome, who is lucky basically and got first. However, in this paper by Aquilina, Buti, and O'Neill, they show a little bit of a different picture. So here, look just at the green bar and the blue bars. The picture come from their paper. The green bar is the number of races won. The blue bar is the liquidity provided in races. So what they show is first that top firms disproportionately snipe. So they take 80% of the races, but they only provide 42% of the liquidity. And even within this top 6 group, there are quite a lot of differences because 2 firms that in the graphs are the balance in top 6 basically engage significantly in both stale quote sniping and liquidity provision. You can see that the green and the blue bar are nearly equivalent. So this would be in line with Marius and Michael model. But then 4 HFT firms that are takers here in the picture engage significantly more in stale quote sniping than liquidity provision. And you see how big is the green bar here compared to the tiny blue bar. So this for the top 6, and then what about everyone else? So match race activity actually consists of firms in the top 6 taking liquidity from market participants outside of the top 6. And here you see like how big the blue bar of the liquidity provided in races is for the last group. So some comments related to this result from Aquilina and co-authors. First of all, HFT firms seems to adopt different business models, and it's unclear why some focus only on snipe pairs and others not, despite that they're all at the top speed level. So as you know, some results of the model really seem to depend to this HFM equal HFS idea. I mean, I quote one of the results, but Mario already discussed the result in his presentation as well. So you wonder a little bit, you know, how this is going on. And of course, it becomes more difficult to assess the impact of a regulatory intervention on a group of heterogeneous agents compared to a group of homogeneous agents. By the way, I totally feel that it's not, you know, completely fair to discuss closeness to reality of a theoretical model. I'm a theoretician myself, but here, you know, the model is very applied with a very strong policy proposal. So I think it's fair, you know, to put a couple of points on this. You know, of course, I'm not pretending that you put all this in the model, but I think some discussion in the implementation part of the paper about this should be included. And of course, one point is also, you know, what is the role of low liquidity providers, right? And I know that in Aquilina, other propose a simple extension, including all these low liquidity providers, a discussion about what would happen in your model, you know, if anything, maybe everything is just robust. So now, getting to the most interesting part of the model that for me is the choice of the exchange. So the Microburst Fee, you have this monopolistic exchange that maximizes revenues for the highest fee such that the snipers still all snipe. So that's the top fee level. As Marius said, unfortunately, in a non-cooperative equilibrium, they will have Bertrand competition kicking in, everyone going for a super high fee level, too high, and basically ending up in a no sniping, no revenues level. And this clearly impacts the comparison between the Microburst fee and the collocation fee. So in the short run, exchanges may still have an incentive to go for the Microburst fee because this allows to put lower spread and attract volume, but in the long run, no one is interested in an equilibrium with no revenue. So clearly exchanges will stay away from such an equilibrium. So only possibility, regulatory intervention that basically cap the fees and avoid this no revenue outcomes. So now get into my comments. First of all, collocation versus Microburst fee. One point that was puzzling me, but you know, maybe Marius and Michael are going to tell me this is not an issue, is that exchanges can be very different in terms of executed volume and other characteristics. Take US, we have 16 of them. I would expect them to charge different collocation fees depending on their market power. I wouldn't expect NYSE or NASDAQ to charge the same collocation fees as the tiniest of the other exchanges. So could this discourage adoption of the Microburst fee? Can we think of, you know, powerful exchanges colluding, or can just the small exchanges push their way through and force the large exchanges to sort of follow in a certain sense? And if small exchanges can push their way through, could the Microburst fee, you know, and going, you know, very extreme, encourage market fragmentation because all of a sudden it's very easy to open a new exchange. No one has to pay collocation fees. You can just allow anyone. And then if they use the exchange, they charge the Microburst fee. And then second point, are really collocation fees and Microburst fee perfect substitutes? You really have a little bit of an idea that you can, you know, replace one system with the other. But while I see the Microburst fee as linked only to low latency arbitrage, I wonder whether HFT's collocation ranks are a bit broader than just pure low latency arbitrage. And, you know, it could be that even exchanges can extract a smaller slice of rents using collocation fees. The cake is a little bit bigger in this case. But, you know, here I'm open to discussion. It was just, you know, coming, you know, as a curiosity. And a last point on collocation is this idea of free collocation that, you know, was puzzling me a little bit. So the model does not, you know, it's already complicated enough. And of course, you know, cannot deal with every reason, does not address the entry of exit of HFTs after the policy switch from Microburst fee and the elimination of the collocation fee. But in the back of my mind, I was having this idea, free collocation is a little bit equivalent to free entry in HFT business. So what should I expect? I mean, slow traders would all transform in fast traders. which HFT business model would be the winner, market maker plus sniper, sniper and earner. So there are a lot, here, the question are just some of possible questions that arise with that, but you just wonder, like, if you really make nearly very easy to enter in the HFT business, what are going to be the long-term consequences? Can we just only isolate the low latency problem, arbitrage problem, and forget about the rest? And this goes a little bit to my last point, that is, the regulator's dilemma. So one thing, the only minus that I find about the Microburst fee is that really it's not a market-based solution, but it requires a regulatory intervention. So, because, going back to my previous point, it's always tricky to discuss about policy changes when analyzing a partial phenomenon. Of course, this does not go only to Marius and Michael paper. It's a general problem I have when we make a big policy change just to fix one point and then maybe forgetting a little bit about the large picture. So low latency arbitrage is just one aspect of the HFT industry, an industry that may change consistently with free collocation. And second, I also don't like so much this role of the regulator in allocating rents between HFTs and exchanges. It seems a little bit is cutting the pie between the two sides. And, you're wondering what is the right way to cut, and, what are we trying to maximize in here? Is it liquidity? Is it welfare? Marius and Michael, to be fair, don't go that far. They just say, okay, these are the ranges of possible, and, it could be within this range, and we obtain these effects. But if in the end the regulator has to make a cut, what it should decide. And I'm really going extreme. Should it just be simpler to ban collocation fees and push everyone on the Microburst fee and let the market do its work? But of course, this is provocative. So, I have some additional comments, but I don't have time to go through that, because I can see that I'm nearly done. So I will leave this for the open room discussion at the end. Maybe we will go back to this point. So to conclude, it's a very interesting paper. I really enjoy reading it. It's ambitious, and with a new original policy proposal to address the low latency arbitrage. The Microburst fee has very nice properties. It is incentive compatible, competition proof. As I said, the only small minus that I find is that to be implemented, it requires regulatory intervention and really a cut on the regulator about how to split the profits between HFTs and exchanges. And it's not easy for me to understand how that should be done. And as the last point of all my discussion, really wish that the effect of the removal of the collocation fees were discussed a little bit more in the paper. It just goes as, okay, we replace one system with the other. I think it would benefit the paper to discuss a little bit more, the broader picture of such a change. Thanks a lot. I hope I was more or less in time.